Back in 2015, you could buy the median American home for about 690 Bitcoin. Just think about that for a second. 690 coins. Fast forward to the beginning of this year, 2025, and that same home costs less than 5 Bitcoin. This isn't just a market shift. It's one of the most violent and dramatic transfers of value between two asset classes we've seen in modern history. It represents a fundamental challenge to everything we've been taught about building wealth. For generations, the road to riches was paved with property. Today, it seems that road is being paved with digital code. So the question on every investor's mind is this: a decade from now, what will have been the smarter play, Bitcoin or real estate? In this video, we're going to tackle that debate head on. We're not talking about opinions or gut feelings. We're going to look at a decade of data, a head-to-head comparison, to give you the clearest possible picture of where to put your hard-earned money for long-term growth. So many people feel like they're at a crossroads, paralyzed by choice. On one hand, you've got the tangible, trusted asset that has built empires for centuries. On the other, a new digital force that has created more wealth and done it faster than anything before it. The fear of missing out is real, but so is the fear of losing it all. My goal here is to cut through the noise. We're going to break down the pros and cons of each, not as enemies, but as tools in your financial toolkit. We'll analyze them across 6 key areas: growth, cash flow, leverage, liquidity, volatility and risk, and finally, taxes. By the end, you'll have a framework to help you decide which asset or what combination is right for your journey to financial freedom. Let's kick things off with the main event, the explosive, almost unbelievable story of growth. That number from the start wasn't just for shock value, it's the core of this whole conversation. Let's break down the actual numbers. In 2015, Bitcoin's price bounced around a lot, but a fair yearly average was about $320 per coin. At the time, the median US home price was roughly $220,000. A little quick math shows that it would have taken around 690 Bitcoin to buy that house. Now, let's jump to today, late 2025. The housing market has had a pretty good run itself. That median home price has climbed significantly, now sitting around the $400,000 mark. That's a nearly 82% increase in 10 years. If you bought that house, your asset has almost doubled in value. That's a solid, respectable return by any traditional standard. The kind of growth our parents and grandparents built their wealth on. It's a return that outpaces inflation and builds real equity. But then there's Bitcoin. From its 2015 average of around $320, Bitcoin has been on a wild ride of insane volatility and astronomical growth. It's seen brutal bear markets, including an 80% crash, and euphoric bull runs that have grabbed global headlines. As of late 2025, the price is hovering around $120,000 per coin. So let's run that math again. That same $400,000 median home today would cost you just 3.33 Bitcoin. Let's put that in perspective. The best way to measure one asset against another is to price it in terms of the other. Priced in US dollars, the house went up. But priced in Bitcoin, the value of that house has completely collapsed. It fell from 690 BTC to 3.33 BTC. That is a 99.5% drop in value. Your house, the cornerstone of traditional wealth, lost 99.5% of its value against Bitcoin in a single decade. This doesn't mean real estate is a bad investment. An 82% return is objectively good, but it shows the sheer mathematical violence of Bitcoin's appreciation. Over the last decade, Bitcoin has produced a compound annual growth rate of over 70%. No other asset is even in the same ballpark. For an investor focused purely on capital appreciation, the data is overwhelming. The historical numbers show that while real estate takes the stairs, Bitcoin took a rocket ship. The question, of course, is whether that rocket has more fuel or if it's going to fall back to Earth. But based on the last 10 years, the winner in the growth category isn't just Bitcoin. It's Bitcoin by a margin that rewrites the investing rulebook. Growth is thrilling, but you know the old saying, revenue is vanity, profit is sanity, but cash is king. This is where real estate has always worn the crown. When you buy an investment property, its main job, besides appreciation, is to make you money every month. You get a tenant, they pay you rent, and after you pay the mortgage, taxes, and insurance, the cash left over is yours. That's positive cash flow, and it's the lifeblood of a real estate investor. A well-chosen rental property can give you a steady, predictable stream of income that doesn't care about the daily drama of the financial markets. Whether stocks are up or down, people need a place to live, and the rent is due on the first. This income provides stability. It can cover your living expenses, help you pay down the property's debt faster, and most importantly, give you more capital to buy more cash flowing assets. It creates a beautiful wealth building cycle. Of course, it's not totally passive. Tenants can be a pain. Toilets break at 2 a.m., roofs leak. You can have vacancies that mean no income that month. Plus, there are ongoing costs like property taxes and maintenance that nibble away at your profits. You either manage it yourself, which costs you time, or you hire a property manager, which costs you money, usually about 10% of the rent. But even with those headaches, the model has been proven for centuries. Own a real asset that people need, and it will pay you. Now for Bitcoin. For the longest time, the big knock against Bitcoin was that it produces zero cash flow. Unlike a stock that pays a dividend or a property that generates rent, Bitcoin just sits there. Its only value comes from the hope that some greater fool will buy it from you for more money later. For a while, that was pretty much true. But the financial world built around Bitcoin has changed. Today, you can actually make your Bitcoin work for you and generate a yield. You can lend it out on different platforms or through decentralized finance, DeFi, and earn interest. The yields can be really attractive, sometimes much higher than what you'd get from a rental property. But, and this is a huge but, these methods come with a totally different set of risks. Lending your Bitcoin means you're trusting that platform not to get hacked or go bankrupt. If they do, your Bitcoin could be gone forever. DeFi is the Wild West, full of bugs and exploits that can drain your funds in an instant. These are not the same kind of risks as a tenant being late on rent. Real estate cash flow is anchored to the real world need for shelter. Bitcoin yield is anchored to the highly speculative and volatile world of crypto trading. So, when it comes to cash flow, real estate is still the undisputed champion of stability. The income from a rental is reliable in a way that crypto yields just aren't. If your main goal is building a stable monthly income, real estate has a track record that's impossible to ignore. Bitcoin offers the potential for high yields, but it comes with high-tech, high-stakes risks that most people shouldn't be taking. Leverage is one of the most powerful and dangerous words in finance. It's the ability to control a big asset with a little bit of your own money. And when it comes to using leverage, real estate is in a class all its own. Here's the magic of a mortgage. You can buy a $500,000 house by putting down just 20%, which is $100,000. In some cases, you can put down as little as 3.5%. This means you are controlling a $500,000 asset for a fraction of its price. Now, let's say the housing market goes up by 5% in 1 year. Your $500,000 property is now worth $525,000, a $25,000 gain. But you only put in $100,000 of your own money. Your return on investment isn't 5%, it's 25%. That's the superpower of real estate. You get 100% of the appreciation on an asset you only paid a fraction for. On top of that, the loan you get is usually a fixed rate 30-year loan. As inflation goes up over those 30 years, the real value of your debt goes down. You're paying back yesterday's loan with tomorrow's cheaper dollars, all while the asset is likely going up in value. It's an incredible wealth building machine. Now, you can use leverage with Bitcoin, but it's a completely different animal. Using leverage in crypto usually means trading on margin or with futures contracts. You might see offers for 3x, 5x, or even 100x leverage. Sounds amazing, right? If Bitcoin goes up 5%, a 10x leverage means you just made 50%. The problem is, it works both ways, and there's a terrifying word in crypto, liquidation. If you buy a house with 20% down and the market drops 10%, you're underwater on your loan, but as long as you keep making your payments, you still own the house. In the world of crypto leverage, if you take 10x leverage and Bitcoin drops by just 10%, your entire position is wiped out, gone forever. The exchange automatically sells your holdings to cover the loss. This is why you hear horror stories of traders losing everything in minutes. The leverage in real estate is stable and designed for the long term. The leverage in crypto is volatile, designed for short-term speculation, and absolutely unforgiving. When you compare the two, it's not even a contest. Real estate offers a kind of safe leverage that is arguably the most powerful tool for the average person to build generational wealth. The ability to control a large, appreciating asset with a small down payment and a long-term loan is a financial superpower that Bitcoin just can't match. For the strategic use of leverage, real estate is the decisive winner. Imagine you own two assets, each worth $500,000. One is a house, the other is Bitcoin. Suddenly, you have a major emergency and you need that cash fast. This is the test of liquidity. How quickly can you turn an asset into spendable money without losing a big chunk of its value? Let's start with the house. Selling a property is a notoriously slow and expensive ordeal. You have to find an agent, prep the house, list it, conduct showings, and wait for offers. Once you get one, you go into escrow, which is a mountain of paperwork, inspections, and appraisals. The whole process, from listing to getting paid, can take months, and it's pricey. Realtor commissions, closing costs, and taxes can easily eat up 6-10% of the sale price. On your $500,000 house, that could be up to $50,000 in fees. Real estate is the definition of an illiquid asset. Now, let's look at Bitcoin. You need the $500,000. You open an app on your phone, hit sell, and within seconds, the transaction is done. The money is in your account. You can then wire it to your bank, which might take a day at most. The crypto markets are open 24/7, 365 all over the world. You can sell everything on a Sunday night or Christmas morning if you have to. The transaction fees are also a tiny fraction of what you'd pay in real estate. Instead of percentages, crypto fees are often just a few dollars. This means you keep almost all of your money. This difference is a fundamental trade-off. The illiquidity of real estate can actually be a good thing for some people. It forces you to think long term and stops you from panic selling on a bad day. You can't rage quit your house investment. But for anyone who values flexibility, quick access to their money, and the ability to react to emergencies or opportunities, Bitcoin offers a level of liquidity that real estate can't touch. It's one of the most liquid assets on the planet. In the contest of liquidity, this isn't even a close fight, it's a knockout. Bitcoin's digital, global, 24/7 nature makes it infinitely more liquid than a physical, stationary, and heavily regulated asset like real estate. Winner, Bitcoin, hands down. If the first 4 points painted a picture, this one adds the dramatic dark shadows. Volatility is the measure of how wildly an asset's price swings, and it's the biggest thing that separates these two investments. Comparing the volatility of real estate to Bitcoin is like comparing a lazy river to a raging waterfall. Real estate is known for its stability. Sure, markets have corrections, but property values tend to move slowly and predictably. A 10% drop in a year is considered a major housing crash. That stability is comforting. It lets you sleep at night. You don't wake up to find your house is worth 30% less than it was when you went to bed. This low volatility nature is what makes it a cornerstone for conservative long-term wealth building. But real estate isn't risk-free. A major local employer could leave town, crushing property values, the government could change tax laws, and there are physical risks like fires and floods. Plus, there's always the risk of bad tenants and unexpected repairs. And then there's Bitcoin. Bitcoin is the definition of a volatile asset. It's not uncommon for its price to swing 10% in a single day. It has gone through multiple cycles of 80% plus crashes. This kind of volatility is gut-wrenching and can wipe you out if you invest more than you can afford to lose or are forced to sell at the wrong time. The risks with Bitcoin are also severe. There's regulatory risk. Governments could still crack down hard. There's security risk. If you lose your private keys or your exchange gets hacked, your Bitcoin is gone forever with no bank or FDIC to bail you out. And there's technological risk. What if a flaw is found in the code or a new technology makes Bitcoin obsolete? However, many Bitcoiners will tell you that this volatility is a feature, not a bug. It's the price you pay for the explosive growth we talked about earlier. No asset can deliver those kinds of returns without also carrying the risk of massive drops. They'll also point out that over the long term, Bitcoin's volatility has been a series of upward waves, with each crash bottoming out higher than the last peak. Ultimately, this choice comes down to your personality. If you're looking for stability and peace of mind, real estate is the far superior choice. Its risks are understood and can be managed. If you have a stomach of steel, a long time horizon, and a high tolerance for risk, Bitcoin offers an unparalleled, though terrifying shot at incredible rewards. There's no clear winner here, only a clear choice based on who you are as an investor. This might not be the sexiest section, but it's one of the most important because it's not what you make, it's what you keep. The tax rules for real estate and Bitcoin are worlds apart, and these differences can have a massive impact on your wealth. Real estate is arguably the most tax-advantaged asset class out there for the average person. The government actively encourages you to own property through the tax code. First, you can deduct the interest you pay on your mortgage. You can also deduct your property taxes, but the biggest advantage is something called depreciation. The IRS lets you deduct a portion of your property's value each year for wear and tear, even if your property is actually going up in value. This phantom expense can slash your taxable rental income, sometimes to zero. That means you can get cash in your pocket every month while legally telling the IRS you lost money. It's an incredibly powerful tool. On top of that, when you sell an investment property, you can use a 1031 exchange to defer paying capital gains taxes completely as long as you roll the profits into another similar property. This allows your wealth to compound tax free. And when you sell your main home, you can exclude up to $250,000 of profit, or $500,000 if you're married, from taxes entirely. Now, for Bitcoin, the tax man is not nearly as friendly to crypto. The IRS treats Bitcoin as property, which means every time you sell, trade, or even use your Bitcoin to buy something, it's a taxable event. Let's say you bought some Bitcoin for $10,000 and it's now worth $120,000. If you use a tiny fraction of that Bitcoin to buy a $5 coffee, you have just realized a capital gain and you owe taxes on the profit from that fraction. This creates a massive bookkeeping headache. If you hold your Bitcoin for more than a year, you get a lower long term capital gains tax rate. And if you sell at a loss, you can use that to offset other gains. But overall, Bitcoin has none of the powerful deductions, depreciation, or tax deferral strategies that make real estate such a powerhouse. In the battle of taxes, real estate wins by a landslide. The tax code is written to favor property owners. The ability to generate tax shielded income and defer gains forever gives real estate a structural advantage that can save you millions in taxes over a lifetime. So far, we've treated this as an either or fight, real estate versus Bitcoin. But the smartest investors know the real magic happens when you stop pitting them against each other. The real question isn't which one is better, but how can I use the strengths of one to supercharge the other? This is where synergy comes in. Think about it. Real estate gives you stability, leverage, and amazing tax benefits. Bitcoin gives you explosive growth and instant liquidity. What if you could combine them? Here's a powerful strategy some savvy investors are using. You start by buying a cash flowing rental property using a mortgage. You use the steady rental income to cover your expenses. You also use the tax benefits, especially depreciation, to free up even more cash. Now, instead of using that extra cash to just save for another property, you use it to systematically buy Bitcoin every single month, no matter the price. This is called dollar cost averaging. You're using the slow, steady cash from your tangible asset to buy a high growth digital asset. But it gets even better. As your property appreciates, you build equity. After a few years, you can go to the bank and take out a home equity line of credit, or HELOC. This is a low interest loan against the value you've built in your property. You can then take that low interest capital, and if you have the risk tolerance for it, make a larger investment into Bitcoin, maybe during a bear market when prices are cheaper. You're essentially turning your slow, illiquid real estate equity into a fast moving, liquid asset with massive upside potential. You've used the bank's money, secured by your stable asset, to buy a historically explosive asset. And the cash flow from the rental can then be used to pay off the HELOC. This strategy lets you have the best of both worlds. You get the foundational stability and leverage of real estate, plus the hyper growth of Bitcoin. Your assets are working together in a financial flywheel. This isn't about being team real estate or team Bitcoin. It's about building a system where $1 does the job of two or three. That's how you go from being just an investor to a true architect of your wealth. So, after a decade of data, what's the smarter long term investment? The most honest answer is it completely depends on who you are. The smarter play isn't a universal truth, it's a personal one. If you're an investor who values stability, predictable income, and the power of safe, long term leverage, then real estate is still an undisputed champion for building wealth. It's a marathon runner built for endurance and reliability. If you're an investor with a high tolerance for risk, a laser focus on pure capital growth, and you value instant liquidity in a global market, then Bitcoin's track record is simply phenomenal. It's a sprinter built for explosive world record speed. But as we've seen, the master strategy might not be choosing between the marathoner and the sprinter. It's about being the coach who has both on the team, using each for what they do best, using the stability and cash flow from real estate to systematically acquire an asset with the high growth potential of Bitcoin could be the most powerful wealth building strategy of the next decade. It's about moving beyond versus and embracing and. Ultimately, the goal isn't to pick a winner between two assets. The goal is to build your own financial freedom. The real takeaway is to understand these powerful tools, know their strengths and weaknesses, and then build a system that is perfectly designed for your personal goals, your timeline, and your stomach for risk.